Did you see GameStop go from $20 to $500? Now, did that make you want to invest? If it did, then there are some important questions you need to answer first, so keep watching. Hi, I'm Elizabeth Naumovski, host of Finance is Personal. What is investing? This question seems to pop up more and more now since the trading and shorting of GameStop and the other stocks during the Reddit Wall Street Bets trade protest. And who should invest? Is it worth it? What's the difference between investing and an emergency fund? So many lines are being crossed right now by a new generation of investors. Today, I'm joined by financial planner Heather Holjevac to answer all of your questions. Welcome, Heather. Thanks for joining me today.
Thank you so much for inviting me.
You know, there's an entire generation that just jumped into the stock market, treating it almost like a game. And I had friends reach out and ask questions about what is investing. And you also had conversations with your son about Bitcoin and GameStop. And one of the reasons why I was prompted to do this show is because I was watching Twitter and there were a couple of things that came up. One tweet that came out said, since everyone who learned about the stock market via Reddit is buying up stocks right now, what app are you all using? And then another one said, oh, a lot of my friends and I use this app and it gives you $20 to start off. My parents even learned how to use it. It's so easy, especially for beginners. And that actually made me think, investing's not about an app. What is investing?
Well, I mean, the basics, really investing is taking some money and allocating it to other resources, whether that is, businesses, real estate, stocks, bonds, mutual funds, and, with the expectation of really generating a profit or income. I mean, you can buy it at one price, sell it at a higher price, hopefully. That's the goal. And otherwise, you could hold it and use it to generate income, interest, dividends over time. I mean, really investing is, it's not just stocks. There's so many other things that you can invest in.
And I think it's important to say that, we saw GameStop go from $20 to $500. It does not necessarily mean that stock or any other stock will constantly make money for you and you'll never lose your money.
Yeah. And I mean, really, it's all about making informed decisions. So when it's easy to jump on the bandwagon and, interestingly enough, my son, texted me, with all this going on, because he actually used to work for the Canadian, which is EB Games. So, and he was saying, well, how is this happening? Why does it make sense? Because he, working in the industry, I mean, he's a gamer and he doesn't go into the store to buy anything anymore. So, one thing that you have to look at is the fundamentals of a company. So I think with GameStop, it was more about a group of people telling other people to, using social media. I mean, we've seen how social media can really be used as a tool for, good and bad. Mm-hmm. So really it was a way for people to band together and move a stock. And really, as long as there's someone willing to buy a stock, the price will continue to go up. And when everyone is selling, then there's pressure on the price to go down. So, some people did make money, and it's not that it's not a bad thing to invest. It's just understanding why you're investing, what the company is about, does it make sense, is there value? And generally, those are the underlying principles that are going to add value to a company. So GameStop, unfortunately now it's hovering around $50, $52. And there was people that made money, but I mean, I read so many stories, unfortunately, of people that, this one guy was saving for a car, put $30,000 in and at $200 and now it's $50. So oof. How is that ever going to recover? Because there has to be a lot of value in the company. And, really it was more of a herd mentality pushing something. And it just so happened that it was GameStop. It really could have been any other stock, I think.
And that's one of the reasons why I wanted to do this show, because of all the social media hype, because it was trendy, because, people were talking about it and tweeting about it, and everybody wanted to jump in. And I want this show to be an educational piece for people in their 20s, their 30s, their 40s, people that have never invested before, that help them understand what's happening right now, because everybody thought that they should jump in. There was so much hype, and that's not a way to invest. And you had just talked about, investing in companies. How do you choose a company to invest in?
Well, really, it's all about doing some research and, looking at, what I try, tell people is kind of look at something that's important to you. Look at what you're doing, because how many people are buying Amazon? So if you look at stocks that have done well over the past, 6 months to a year, grocery stores, Amazon, Apple, anything technology, Zoom, actually, so look at kind of what the trends are, and that's generally what is going to be a good stock to buy. And you also need to look at the fundamentals of the company. I mean, there's a whole course. The Canadian Securities Commission has a course you can actually do if you want to know more about stocks. There's all kinds of places to learn about, where to, get information. So, for example, you can, look at even the government of Canada, Canada.ca, has little courses that you can take on investing and debt and what a stock is, and there's companies like Wealth Simple, and there's lots of information out there. It's really picking, looking at what your objectives and goals are, and having something that's diversified, because when you just pick one stock, if that stock doesn't do well, then you're tied into just that specific investment. So there's, setting up goals and objectives and a
risk
plan
tolerance
really
as well.
Well, risk tolerance, absolutely. And I think that, there's investing and then there's savings. So, those two objectives have, are a bit different for everyone. So, at the end of the day, it's really just looking at doing some research and people, just look at what's important to you, and and that's kind of the first place to start, because then you can see that, what you do, really does affect the value of a stock.
So because I wanted this show to be educational to 20, 30, 40-year-olds, people that have never have never invested before and don't quite understand the industry, I actually reached out to a few people and had them send in some questions. And one of the questions was, who should invest?
Yeah, I mean, really, anyone should invest. I mean, as long as you have some disposable income and you want to learn, there's a misconception that you have to have a lot of money to invest. But I also think that you have to look at your situation. So you can invest, but you also have to look at, do you have the funds to do that? And even though over the long term, investing will provide value, in the short term, it may not. So you have to really look at, is that money that you can set aside and not worry about? There's all kinds of different strategies. So there's, you should look at paying yourself first, getting, setting up a budget and looking at what your expenses are and what your needs are. And also looking at, debt, because you don't want to invest and make maybe 10% when you've got debt at 19%.
Right.
So that, you have to look at, what your objectives are, and make sure you've got, fits into your long-term goals and your short-term goals, and
an emergency fund as well. I mean, that's one of the key things.
Yeah.
Because especially right now, and that we, with the pandemic and everything else that's happening, so many people are losing their jobs, and you need that cushion. You need that piece of, whatever it is that you put away into your emergency fund, or if you need to replace a roof on your home, or you need new tires on your car, that's really important to have as well.
Yeah, absolutely, because that gives you the confidence to know that you're going to be okay if something happens. It's really, kind of that pay yourself first. Just making sure that you're taken care of, making sure that you've got a contingency and that you don't have to draw on debt to pay your bills, or to, that you're going to have some cash flow available. So really there's a few steps. So there's the emergency fund, and then looking at, investing for the short and long term for specific goals. And then if you want some play money, then figure out, maybe, take $500 and set it aside into a discount brokerage account and play with it. And that's really, the only way you're going to learn. Or you can also set up, like a virtual account. So there's different apps that you can look, and you can pretend to buy the stocks, not actually put money into it. And that's really the way you learn anything, is just by trial and error.
Absolutely. So one of the other questions that came in was an entrepreneur. And the question was, what about someone who's living paycheck to paycheck? Is it still worth investing $25 per month? And if they're investing, what's the least amount? And then, if they're desperate for money, do they touch it? Isn't it just, if they need to touch it, isn't investing a waste anyway? Because, if you need that money, you just pull it out.
Yeah, and that kind of goes back again to, setting up a strategy, like making sure you have the emergency fund. I think that, if you're living paycheck to paycheck, I mean, we all have expenses that we don't have to have. So, there's nothing wrong with, having Starbucks on a daily basis, but maybe have one less Starbucks a week. Take that money and set that aside and split it. If you want to have part of it invested and part of it for savings, you could also prioritize it, put, maybe $5 in your emergency fund and $5 in your investing fund. So I think that it's always a good idea, even if you're living paycheck to paycheck, to try and find, a little, even $5 or $10 extra just to set aside. Really look through, your expenses. And a budget is not about telling you what you can't spend. All it is reviewing what is important to you.
Mm-hmm.
Because I think there's all kinds of things, even on, for example, some credit cards have insurance costs on there. So you have to look at your recurring costs, and it's just really doing an audit of your expenses. But I think definitely does make sense to save a little bit. And the least amount, I mean, really, $5, $10, it seems like it's a little bit, but it does add up.
Yeah, absolutely.
And that's why, if they're desperate for money, you've got that emergency fund, so you don't have to dip into it.
So I know you and I are huge financial literacy advocates, and this one question came in, and I know that we are both completely against debt. It's like, get rid of the debt, get rid of it, it's evil, go away. Now, one of the questions that came in from this entrepreneur is, should I borrow to pay bills, or should I borrow to invest?
So I think that it's never a good idea to borrow to pay your bills, so as an entrepreneur, though, the borrowing costs actually are an expense. So it could be beneficial as a write-off. So for the average individual, you can't write off those expenses, but as an entrepreneur, you probably could. So it may make sense in that situation. The other way it may be good to borrow is if you have reward cards, but you have to have a discipline to pay it off at the end of the month, because you can get some really good rewards. I mean, my son used it and daughter use the Scene card, and now it's gone from movies to food. So I mean, they can, by using their credit card, paying it off at the end of the month, they have extra money to pay for food and things like that they wouldn't otherwise have.
But the key is to pay it off at the end of the month and not just pay the minimum. The key is you pay it off at the end of the month.
Right. So, I mean, it's a strategy. So what you do is you set aside the funds that you know you're going to spend, but spend it on the credit card, and at the end of the month, pay it off. But again, it's all, discipline. And, for borrowing to invest, generally, again, it doesn't make sense, but there is actually a strategy that Revenue Canada will allow you to deduct interest if you borrow money to invest. And as long as the rate of return on the investment is higher than the rate of return on what you're borrowing. So it doesn't make sense to use credit cards at 19% because, it's unlikely you're going to find a 20% rate of return investment. But, where interest rates are low now, again, it's all about making sure that it makes sense for you, that it's not going to put you in a deeper debt position. It should put you in a better off position. But generally speaking, it's not a good idea to borrow to pay bills.
Yeah. And so I want to talk about RRSPs, registered savings, TFSA, tax-free savings account, and a savings account. Through the years, I've hosted shows for 20 years plus, and in the call-in show, and people would call in and say, I just bought an RRSP. And a lot of people have mixed up the terminology of an RRSP because our industry is very acronym based. Registered Retired Savings Plan. It is not, you don't buy an RRSP. I keep telling people an RRSP is like a wallet, and you put money in it, or you put stocks in it, or certificates, or whatever it is. So maybe you could explain an RRSP and a tax-free savings account.
Yeah, I mean, I look at it in kind of buckets. So an RSP is, or think of it like as a circle. So within that circle, there's different things that there's tax implications, and you have to look at what situation you're in. So an RSP is a savings vehicle that allows you to put money in today, get a tax benefit, and then earn money tax sheltered until you take it out. And generally it's for retirement. And then at that time, when you take it out, it's taxed again. So you're still going to get taxed on it because you get the benefit of the RSP deduction from putting it in. So what you have to look at is, and some people, again, don't talk about, does it actually make sense to put money in an RSP? Because if your tax situation today is the same as your tax situation in the future, there's really no economic benefit to put money into an RSP. But we're told that that's the only way you can save for retirement. So generally, if you don't have if there's not a tax benefit, then you look at a tax-free savings account. So within a tax-free savings account, you can put the exact same things that you can put into an RSP. So it's just another vehicle, but it has different terms around it. So when you put that money in, it earns again sheltered, so you don't pay tax on any gains. And then when you take it out, there's no tax implications of that as well.
So there are a lot of people always say, how can I make the most return without losing anything? What do you say to people that come to you and ask that question?
Well, I mean, everyone wants to do that, but unfortunately, as the scale of risk goes up, so, the return goes up as well. So you have to balance risk and return. So the, potential for making the most, is obviously going to be stocks or, small cap or something that's got the ability to go up at a large percentage. But unfortunately, those also have the most risk. So GICs at this point, I mean, when I started in the industry, and probably, you remember GICs were 11, 12%, if not more.
I think they were 18 back in the 80s or something.
Yeah. So there was no risk. You basically put your money in, got your 18%, but the benefit was reduced because you have to pay tax on that. So there's all, different competing, so there's tax implications, risk implications, liquidity implications. So it really just depends on what's important, to you. And if you're looking at the long term, a balanced portfolio of stocks and bonds will generate, a great return. I mean, if you look at pension funds, I mean, they're required to make at least a 7% rate of return. And so they have to find investments to do that. So they, they're still investing in bonds because that's safe. They're investing in stocks. And then there's also alternate funds now that people are talking about. It's a hybrid. So you're looking at real estate funds, things like that. So that's a loaded question. It's hard to answer because it's really different for everyone.
Well, then that's just it. And that's the key to investing. And I'm glad you said that because, it's that whole know your client. You have to know how much money someone makes, how much debt they have, what are their obligations to their family, their home, what type of risk that they'll take. So these are loaded questions. I absolutely. However, they're actually the questions that are coming up with people that are in their 20s, 30s, and 40s. And so, I know that they're loaded and I know that I'm putting you on the spot, but, I know that you're trying to answer them as the best that you can.
Diplomatically?
Yeah, I think diplomatic's a good word. Okay, so now I'm going to really throw you in because another question was, are there any options other than the stock market to invest? And you were saying that your son was talking to you about Bitcoin.
Mm-hmm. Yeah. And again, it's really, as you can invest in all of these things, GameStop and Bitcoin and gold, and individually they have a lot of risk. But if you have a little bit in each of them, then that balances out your risk. And you could still make, some money if you have investments over, a number of categories. So it's not just investing in stocks. So look at, real estate as an investment. They're, stocks, bonds, even though people don't like bonds, they're safe and secure. Yeah. Even, annuities. There's all kinds of, products out there. It just really, again, it goes back to, what's important to you. And I think that, people may be listening and saying, oh, it's easy for you to say, you've been in the industry for a while. And, but really, I'm thinking back, to when I started. I wish someone had said, you know what, just be disciplined, just start. Because the earlier you start, the compounding effect of money invested over time is amazing. And the more, and it ends up coming like every year. For example, if you're making 10% on $10,000 versus 10% on $100,000, it just, the cumulative effects and compounding are just remarkable. So, I do wish that someone had, said to me when I was younger, start investing. And again, there's all kinds of opportunities. Like one of the, a little bit off topic, one of the biggest missed opportunities, I think, is pension plans. So companies that have a matching program, it's free money. Free money. Where are you going to get it? Where are you going to get 100% return?
Yeah, so. You're 100% correct. And one of the things I want to say is, that's why I always tell people, reach out and speak to an investment advisor, a financial planner. They have the answers to your questions, and those answers will be tailored to who you are, what you want out of your investment, your risk tolerance, and everything else. Too many people think, oh no, I'll just do it on my own or whatever. And they end up losing a lot of money. And then they'll say the stock market's not for me. There's so many different stories that you hear from other people. And I always just say, hey, just reach out to someone in the industry. They will help you. That's what they're there for. That's their job.
Well, and that's right. And there's so many people in the industry that are there to help you. And you really should look at interviewing people, because I'm not going to be everyone's who everyone wants to work with, and but there's someone out there for you. So some people are just looking to for stocks. Some people need tax advice. Some people, just need the basics. So it's really important to do some research. I mean, there's so much online. Not all of it is good news, or true. But I think, people are smart enough to figure out what makes sense for them. And, what I told my son is take $500 and throw it into, GameStop. I mean, at the end of the day, it's not the end of the world if you lose it, but it gets you an understanding of how the market works.
So I think this has been a really good conversation because it's really stirred up a lot of questions and answered a lot of questions for a lot of people. And I hope that this conversation will actually entice them to start saving for the future. What last words of wisdom do you have for someone who is, 25 years old and thinks, why do I need to worry about saving my money?
Again, it goes back to compounding, and it's just about to setting goals and to have a plan and to just start, because once you start that, $5 and $10 setting aside, you don't miss it. And if you don't miss it, then eventually you'll be amazed how much it accumulates. And it's really all about, we're not going to work forever. So it's really just your current self paying for your future self to have a secure future. Really, that's, and just talk to someone, that you trust. And, we're all in the industry here, wanting to help people and, make lives different and make it make it better. And I think that is just about conversation and just to start.
Okay, Heather, I was going to ask you about FOMO, the fear of missing out, and YOLO. Drake always sings about YOLO. You only live once, but you don't invest that way.
No, I mean, there is the generation that, has that mentality that you only live once, which is a great thing to think about because it is true. I mean, you never know what life is going to bring, but you can't only live that way because, we've seen in the past year with the pandemic, if you don't have a contingency plan, if you don't have something saved, then, it's really difficult to even, sleep at night if you know that you're only just spending for today, because, the fear of missing out and, FOMO and everything, it is a great way to get you to do things, but it also, you really do have to think about your future, because if you only live for today, again, there's no way that you may be working, until you're 60, 70, 80, you never know if if you don't have that contingency plan.
So those are great words of wisdom. So the bottom line is the right time to start saving is today, right now. Thank you so much for joining me today, Heather.
Thank you.
The key to investing is realizing that you're in for the long haul. Investing is about the future, and there really is no fast, easy solution without taking on a lot of risk. Investing is not about trading while you're waiting for a friend to pass the time. It's strategic. It's about participating in the long-term growth of the economy, and it's about discipline. Understand how an investment works and understand the risks associated with the investment. It's about saving enough money for your future so that you can live your life with enough to meet your living needs without worrying. Develop a plan and follow through on that plan. Be careful of investing in something trendy or because a celebrity or someone else has endorsed it. Speak with a professional. Remember, past performance is not indicative of future returns. Please subscribe to my YouTube channel and follow me on Twitter. And don't forget to read the disclaimer. Thank you so much for watching. Bye for now.